Hey, it's Stuart. I've got a really interesting question from Joey on YouTube. And let me just take a moment. I'm going to read the question out verbatim. So, Joey writes, my partner and I are ordinary PAYG employees with a combined income of around $200,000. Right now, we can afford to buy an investment grade inner city terrace home for about $1 million. If it compounds at 7%, you often reference, that same terrace is roughly $8 million in 30 years, right? Big number. Far beyond what our wage multiple could ever borrow. You've said the richest 25% will still be able to buy at that level. My question is why? Who are those top quartile households actually bidding against to drive the next leg of capital growth? When households without other sources of wealth out of the picture, who are they having to outbid to continue to drive up prices? Why would they fight over a small 2-bed, 2-bath, which is already on a shrinking 2 to 3% yield on a reasonably small block of land? These properties would presumably not be purchased to live in by the very wealthy unless we see wild population growth. I think we're seeing wild population growth and have done for many years anyway. So can we assume that the future sale will be an investor? If I sell in 30 years, what would the investor need to see to exit with a similar sort of growth 30 years after that? Good question. With the shrinking buyer pool and declining yields, what factors are at play to make them think that they will receive the required growth rate to make their purchase a good investment and justify such a return for me? In short, we are wiping out a huge proportion of our demand when we extrapolate out our desired capital growth. And I cannot think of a mechanism on the supply side which would cause it to decrease in such a way that the imbalance is preserved to ensure ongoing capital growth. Would love to hear your thoughts. Really interesting question, Joey. And the reason why I'm recording a video response rather than a text response is that there's a lot going on in this question. But it's a really important one and something for us to all form a view on. I guess the answer is no one really knows, but we can look at history as a bit of a guide. The other thing too, it's very, very difficult for humans to get their head around the impact of compounding capital gains. And it's something we should acknowledge that we've got a bias. There's a bias there from a human bias for us to be able to extrapolate how numbers can compound over a long period of time. So you're saying the $1 million terrace, 7% or let's say 7.2% because you're doubling every year, it's going to be $8 million in 30 years' time. That number just seems so ridiculously large today. And it is, it's a big number. But if you take out inflation, so if you say inflation's 2.5% over that time, in real terms, it's $3.8 million. So that's probably, you go, okay, it's 4 times the value in real terms than what it is today. That starts to make a little bit more sense, right? If you think back to, the 80s, 40 years ago, the same property would have sold for less than $100,000, probably $80,000. So, you a tenfold increase. Now, if I had told you in the mid 80s or early 80s that it would be worth 10 times the amount in 40 years' time, you would have thought I was crazy, right? So it's very hard for us to get our head around these things, but they tend to happen. So here's the first thing. The first thing is that everyone, when I say everyone, most people, large cohort, want to live in a location that is most convenient for them. So that is very short travel times to work, to school, to entertainment, to hospitals, that offers the most amenity. That's a safe area to live in, that is an area that's nicely maintained, or at least they connect with. If you think about in Melbourne, Brunswick is a bit grungy, but, some people really like that sort of mixture of people and businesses and properties. Whereas you go to Toorak, it's, very high end. Some people like that. But the point is that people want to be attracted to those sorts of locations. So I think the first point is we can say, well, everyone kind of wants to live in this location. The best analogy I can use of how population growth has a great impact on property prices is that in the 70s, and I don't know the exact numbers, but something like this, someone's told me this before. In the 70s, in Sydney, there was 5,000 properties that lined the water around the harbour. And the population was something like less than 1 million people. Today, there's still 5,000 properties that line the water, but the population sort of 6-ish million people. Same thing in Melbourne will apply. As Melbourne spreads out, and Sydney's a bit different, right? Geographically, it's sort of surrounded by water and national parks, can't really spread out like a Brisbane and like a Melbourne. But that doesn't really matter so much because as Melbourne spreads out, unless we build substantial infrastructure, not going to happen, living further and further away from the CBD is going to be less and less attractive to most people. Not everyone. You're going to say, some people can work from home and these sorts of things. That's true. But for most people, it's going to be offer a sort of lower amenity in terms of living standard. So the same thing's going to happen as the story about property around the water in Sydney. The same thing's going to happen in Melbourne, that you go and live in Brunswick or Hawthorn or Richmond or Prahran. There's only a certain number of properties there in terms of house blocks. And, they're going to become more and more and more desirable. And so that's you've got to subscribe to sort of this way of thinking. You've got to kind of agree with those sorts of ideas. And Point Piper in Sydney is a great example, right? Very small suburb, very sought after, but the land values are extreme. Not everyone can live in Point Piper, but there's enough people that can afford to live in Point Piper to keep pushing the prices ahead. And this is what I'm really talking about. It's not, I use conceptually top 20, top 25% of wealthy individuals just to sort of cast the net a little bit wider, because not everyone can afford to invest in Point Piper. But we don't need to get caught up in the numbers, whether it's 25, 20%, 10%, whatever it is. The point is that there's going to be a cohort of people that can afford to pay more. And Point Piper might cost you, $20, $30 million to buy an apartment with a view. It's going to cost you probably $60 million in 10 years' time. Now, who's paying that sort of money? Doesn't matter. There's enough of them to pay that sort of money. The other thing too is that the people that are attracted to that area, or the people that might be able to buy into that location in 10 years from now, might not be able to do it today. So there could be a change. So it's not just the people that already live in that area, it's the people essentially that those higher income earners will be attracted to that location just because they're highly desirable. So where are their sources of wealth going to come from? There's heaps of sources of wealth other than wage increases. So it could be investments. Let's look at crypto. One of the higher sales in Toorak, I don't know if it's still the case, but certainly the last couple of years, was to some young guy that made a huge amount of money out of crypto. So, investments, I think there was another one that had an online gambling business that did pretty well and bought a massive property in Toorak. Thing is, when these sort of windfall gains, if you like, when people sort of run into unexpected money, some of it always ends up in the property market. Could be people at the top of their game, CEOs, CFOs, barristers, these sorts of people that, that like in any industry, the top, 10 or 5% are earning multiples of the average in that industry. It could be a change in income structure, so I've had clients that were working in a sector earning $80,000, $100,000. And they saw a business opportunity and they started a business, and now they're earning tens of millions of dollars in terms of net profit. These things happen, and these things will always happen. The $3 million super cap What do you think is going to happen there? I mean, people have an incentive now to pull money out of super. That money will find its way into it's not all of it, but some of it will find its way into the property market. The tsunami of inheritances, Griffith University estimates it's about $3.5 trillion that will pass. Now, all that $3.5 trillion isn't yet in the property market, but typically what people do when they receive an inheritance, in my experience, is they upgrade the family home. So even if they don't have, the income to service higher debt because they've got this cash injection, they can now increase that. Employee share ownership plans, more and more I'm seeing clients generate a lot of wealth from stock options or employee shares or these sorts of things from listed businesses that they work with. The point is, we don't really need to worry about necessarily where that source of wealth is going to come from because there's plenty of evidence that it's there. The theory is that there's always going, the top 20% of Australians in terms of wealth will want to live in particular locations. And this is where, I guess, Joey, your question is, well, I'm going to buy this terrace, I'm going to sell it to an investor. This is where I think it falls down, because what we really want to do is we want to have multifaceted demand. So if I thought I'm buying a property today and the only person that's going to buy that property in 30 years from now is going to be an investor, I'm probably not going to buy the property, because that's a bit of an alarm bell. We want multifaceted demand. So I want to be able to sell that property to an investor, to someone that's just getting into the property market, to someone that's climbing the ladder on the property market, to someone that's downsizing, these sorts of things. Now, at the moment, you've got a terrace on that property that's 2 bedrooms, pretty old, et cetera, but that's not really what we're buying. We're not buying the improvements, we're buying the land. And it might be on 200 square metres or 150 square metres. We might argue that's a very small parcel of land. But, try and buy 150 square metres in New York or in a very established, city like that. It's going to be near on impossible. To own a little parcel of land in 30 years' time in a great suburb is going to be really challenging to do. Now, what's on that land might change. That the improvements might end up being a 3-bedroom home or whatever. It might accommodate people that are downsizing and selling the big family home out of Hawthorn into, a smaller sort of parcel of land. Lots of things can happen, but we just know that history repeats itself. And if we buy an asset that is very attractive, that it has very wide appeal, we have the highest probability of earning the highest return. So to my mind, it's reducing investment risk because I've got a pink diamond, if you like, rather than just an average diamond. And I'm positioning myself to earn as much return as possible. Those assets should, over the next 30 years, outperform any other type of property or location of property. That's my idea. Now, what will that return be? Will it be 7.2% compounding on average? Maybe. Maybe it's going to be something less, but all I want is my relative performance to be better than the median house price and just the average property in the middle of nowhere, of course. It's true that I think from a dollar value perspective, the rate of growth will probably slow down. So, and we've kind of seen that if you look at the last 20 years versus the previous 20 years to that, rate of growth has slowed down, although it's been skewed by a whole bunch of more recent factors in the last decade. But I think the answer is that if I buy $1 million property today in a great suburb that ticks all the boxes, that's investment grade, and I hold that property for 30 years, it's likely to make a large contribution to me being able to fund retirement. That is, the equity in that property on an after-tax basis is likely, after 30 years, to make more than a 50% contribution to me funding retirement. And I don't know what property is going to do, but if I buy an above average quality asset, my returns in the long run should be above average. And I don't really need a lot of compounding capital growth. Even 6% is going to generate a lot of dollar value growth. And remember, we're funding retirement with dollars. So from my perspective, then you add all the aspects around the benefits of investing, borrowing to invest in property, compounding capital growth, leverage, negative gearing, all these sorts of things. You put it all together. To me, it seems like a pretty attractive strategy. I want to leave you with one final story. I've been working with a buyer's agent in Melbourne for a long time, probably more than 20 years. And the gentleman that started that buyer's agency helped a client buy six investment properties throughout the 90s and 2000s. I think there was a purchase sort of late 2000s. That client used to work for the transport network. I think it was a train driver, or maybe not even that, maybe that, but it was earning a very, very basic wage. Ended up buying property in Carlton, Hawthorne, some really blue chip, great suburbs. So, has built millions of dollars worth of equity and wealth over that time from a very low asset base. Now, he didn't spend a lot of money. He worked hard, saved hard, all those sorts of things. Now, that's not going to happen anymore. The average person can't buy property like that person did back then. And so that's the thing we've got to think about, like, where will the growth come from? And that's why I think this is a great conversation to have, because a lot of people are buying property in locations where they just fundamentally can't drive the constant growth. I just think we just need to think about, we need to know that wealth inequality gets worse. The top 10%, 20% are always going to be able to outbuy the rest of the population by multiples. And we want to think about where those people want to live or own property. And I think that, not everyone's going to be able to buy a big family home. Not everyone wants a big family home either in those locations. I still think that there's going to be just as many owner-occupiers as investors for those property types. So, Joey, really a long answer there, very long answer, in fact, but it's a great question, and I think it's a great conversation for us to have. Hope that helps. Cheers.